Hey, Finthusiasts! Welcome back to our stock market series. If you've stuck with me through part 1 and 2, give yourself a pat on the back. Now, we step into the derivatives market, a more advanced section of the market that deals with trading contracts. Let's begin with futures, the most basic derivative. What are futures? Imagine this. You love mangoes, and the current price is 100 rupees per dozen. But you think prices will rise next month due to summer demand. So, you make a deal with your fruit seller today. You agree to buy mangoes for 100 rupees next month, no matter the market price. This is exactly how a futures contract works in the stock market. You're agreeing today on a price for a future purchase or sale. Say Reliance stock is at 2,500. You expect it to rise, so you enter a futures contract to buy it next month at 2,500. If the price goes up to 2,600, you earn 100 per share. But if it falls to 2,400, you lose 100. Here's the key. You never own the actual shares. You're trading on the price movement only. How futures work? Let's go deeper with some essential components. Lot size. You can't trade one share at a time. Stocks in futures come in lots. For instance, one lot of Reliance may be 250 shares. So, one contract equals 25,000 times 250 equals 6.25 lakh. But don't panic. You don't need 6.25 lakh to enter the trade. Futures are traded on margin, typically 20%. So here, just 1.25 lakh is needed to control a 6.25 lakh position. That 1,25,000 which you pay is called as margin money. Mark to market. Every evening, your broker checks how much the stock has moved. If it goes in your favor, you earn that difference. If not, you lose it daily. This daily adjustment is called mark to market. Expiry. Futures don't last forever. Each contract has a fixed expiry date, usually the last Thursday of the month. On expiry, the contract is closed automatically. Profit or loss is finalized. Now you might wonder, why even use futures? Speculation. If you believe a stock will go up, you can buy futures and profit without needing the full capital. It's like placing a bet based on your research. Hedging. Let's say you own Infosys shares and worry they might fall. You can sell futures of Infosys. If the price drops, your futures profit will balance your share losses. This is like an insurance policy. Leverage. With just a fraction of the full amount, you control a big position. Great when the market moves in your favor, but dangerous if it doesn't. Risks in futures trading. Here comes the reality check. If the market goes against your position, the losses can be unlimited. And if your margin drops below a certain limit, your broker will ask you to add more money. This is called a margin call. Important, always use stop loss, an automatic trigger to exit your trade when losses hit a certain level. Golden rule. Only trade what you can afford to lose. Futures aren't for emotional or impulsive investing. Should beginners trade futures? If you're just starting, don't jump in with real money. Watch educational content, understand the terms, use virtual trading apps to practice without losing actual cash. Never trade just to chase profits. That's a wrap on the futures market. In the next part, we'll dive into options trading, a cousin of futures that gives you even more flexibility. Don't forget to like, subscribe, and hit the bell so you're notified when part 4 drops. Thanks for watching, and happy learning!